Okay, welcome back. So the SGX Nifty will come up on your screen. Take a quick look and then we'll proceed with our next conversation. 30 points higher, 18,368, right around where we looked at it at 8 a.m. Now, Rajesh Baheti is joining us right now of Crosseas Capital Services. SEBI has released a consultation paper on F&O price bands as proposed changes to curb volatility, information asymmetry in F&O stocks. Basically, what SEBI is essentially saying is that in terms of daily price moves for stocks which are moving circuit to circuit, the amount which they can move should be reduced from 5% incremental moves after circuits. It should be reduced to 2%. There should be greater interval, greater cooling off period from one circuit when between circuits as well. So once the stock hits a circuit and the stock goes into a cooling off period, that period should be increased to 1 hour as well. Rajesh, good morning. Good to have you with us here. Thank you very much for your time. Did I miss anything? I mean, just tell us, how do you look at this paper and how do you read the proposals?
Yeah, to be honest, so I don't profess to be an expert on this subject, but interestingly, you use the word volatility. I don't know if circuit breakers should be used to reduce volatility. Rather than they should serve as just maybe a strategic time out for investors to price in the new data, the new information, and reprice the stock. So logically, I would have thought that after a couple of circuit breakers, if SEBI wanted a fair discovery of a new price, maybe we could have experimented with the call auction process. But it does seem that SEBI does not like that idea. And the intention of SEBI is to reduce the quantum of movement that a stock can have in a day. And if that is the sole purpose, then maybe yes, what SEBI is proposing is okay. But if the purpose is to reprice the stock based on its latest...
Hello and welcome to this Money Control live stream. You're watching Morning Treat with me, Nandita Khemka. Over the next 30 minutes, we'll be talking about the...
Apologies for that. There was some audio disturbance, but please carry on. You were talking about SEBI's intent of perhaps reducing the movement itself, not the volatility, but the movement, because that's the question, right? They're talking about not just increasing the time interval, the cooling off period between the flexing, but they're saying reduce the movement allowed from 5% to 2%. How should we read that?
So I don't know, where I stand on this exactly, because if you look at the American markets, which we think are the most advanced and the most biggest capital markets in the world, you've seen recent events, how banks' data got repriced within a day, and banks lost 70-80% of their market value right away. So America goes to the other extreme and allows all the moves to happen right away. On the other hand, we're trying to slow this down. I think there is a middle ground. My question to SEBI would be, what is so broken in the way the current system works that they want to fix it? What are the recent events that have led SEBI to release this paper? Because I didn't see too much of a problem with the way the things stand currently. So honestly speaking, if the idea is just to reduce price volatility, the problem would be that the price discovery would take place. It would just take longer. And I don't know if that is a good thing as far as stock repricing goes.
Okay. There is a middle ground. America on the other. But there are no real sort of good, right answers, right? There are no correct answers here. It's a judgment call at the end of the day.
Yeah, if you recall, earlier we didn't have price bands on IPO days, and we've had stocks move 100, 200% on IPO days. Of course, in some of those stocks, it was very questionable, the quality of the stock that was IPO'd. But then SEBI opted for the call auction process, that you discover a price at the open of an IPO stock and then set the price bands. So I would fundamentally think maybe a call auction followed by a fresh round of circuit breakers could have been an option they could have tried out. But in their wisdom, they just want to reduce volatility. And if that is the sole criteria and not repricing the stock given the recent data and find a fair value for that stock, I think then what they're proposing is okay. But if the idea is to actually rediscover a new price as quickly as possible, then maybe a call auction followed, after a couple of triggers, circuit breakers, maybe a call auction process could have been tried out.
Is the call auction process followed widely around the world, Rajesh?
So SEBI's paper says that a couple of jurisdictions follow it. The rest have not followed it. We know in America there is no process of circuit filters. So whatever has to get priced in gets priced in instantly. So it is something that one can experiment with, maybe a sandbox. I don't know. The issue is, should the stocks reflect their true new value as quickly as possible, given a change in circumstances or new data? And how much time should you take for that stock to reflect the new reality? I think that's the move question.
Just a final question, Rajesh. In our market, we also have this ASM system, right? The additional surveillance mechanism. And now I think within ASM, they're saying put hard limits for stocks that are already under this mechanism. You think this is warranted? Because there's already an ASM. I mean, those stocks are already on the regulators or the exchange's radar.
We have a lot of things other markets don't have, such as market-wide position limits and so many other things. In many ways, it served us well. With ASM, the issue is, once again, is it about just reducing volatility or trying to reprice the new data that is coming? And stocks will go into ASM, especially in the futures and options segment, only if there is a big breaking news on the stock. Otherwise, ideally, you don't think that a F&O stock that has such liquidity is likely to go under ASM very soon. We've had some recent examples following the Hindenburg exposures that, stocks with market caps of 100,000, 200,000 crores also went into ASM. And they did fall precipitously. But that was, again, repricing some news. And again, that debate is open. I think maybe some intellectuals on this can be called upon to really give us a better way of repricing these stocks.
Okay, all right, Rajesh. Thanks so much for stopping by and giving us your view on this particular topic. Look forward to chatting up with you and wishing you a good day ahead as well.